Hello there everyone. In today's video I'm going to try and explain exactly what has been going on in the bond market in the last 2 weeks. What is all this chaos about? What exactly has been happening? Because we hear it, all the headline news, the markets have gone crazy, but what exactly has happened? Well, it's all started from a decision about 20 years ago. And this was a chap who was in charge of the pension fund of Boots the chemist. And it's what we call a defined benefit pension scheme. So differences between defined benefit and defined contribution scheme are, with a defined benefit scheme, you pay in, but you know with certainty what you're going to get. It's your benefits are defined. It's up to the company who run that pension fund to make sure there's enough in there to pay you out when you retire. But you know for certainty what you're going to get. Such pensions were very popular many decades ago, but over time they've become less and less so. There are still many out there. To compare with defined contribution pensions, which there are more and more of, where you invest, your contributions get invested on the stock market and you hope for the best. If your pot gets to a certain level, great. That is from which you derive your income. Totally different than how defined benefits. But this is all to do with defined benefits. So the guy that ran the Boots pension fund, he said, okay, got a brainwave. He said, look, we've got to honour these pension payouts to pensioners. But in times of crisis and financial crises or whatever, there's a risk that we might not be able to basically meet these liabilities. So what he did, he said, look, I'm going to sell all of the equities in this pension fund. There was like £2 billion worth of equities. And he said, look, instead I'm going to change them for gilts, for government debt. It's a steady investment, virtually risk-free. So that switch 20 years ago by this one guy who ran the Boots pension fund caught on. And then many pension funds, thousands of pension managers over the years agreed with this strategy, and it's called LDI, liability driven investments, basically where the pension funds own a load of government debt. But it has its genesis in the early millennium. It was a real game changer in the pension industry. So fast forward 20 years, what happened? Mini budget, 23rd of September, spooked the markets. What exactly does that mean? Well, the demand for long-dated gilts dropped, fell off a cliff. In other words, there was the demand to buy government debt dropped significantly. Now, in the bond market, prices rise and fall inversely to yields. So if the demand goes down, basic economics say that demand for something goes down, the price for something falls. So the price of the government debt went down, but conversely the yields went up. So the rate of return went up. That's how the bonds move. There's always an inverse relationship between price and yield on these bonds. So the yields of the government debt went up. That's what caused the mortgage crisis, if you will, where all the mortgage providers pull their products because they were trying to price for these fixed rate mortgages for 2 years or whatever, and all of a sudden the yields had gone up, so they would have basically lost a fortune had they not pulled them. So they pulled them and then replaced them with higher yield mortgage, higher interest rates, basically based on the fact that the government debt yield had gone up, all because of the fact that the markets were spooked. And we have this LDI, liability driven investment, going on. So let's take a deeper dive into this LDI. So I said that it had its genesis around about 20 years ago, the guy who ran the Boots pension scheme, and then many others followed. So LDI strategy, if you're a pension fund manager, so you basically use derivatives. Now, derivatives are a type of financial instrument. In this case, it's what we call interest rate swaps. And they use derivatives to help pension funds match their assets with the liabilities to minimize the risk of shortfall. Because like I said, on defined benefit scheme, you are committed to paying out to the retirees, even if the performance of the fund hasn't done so well. You've got that liability. So there's a risk there that you might not be able to afford to pay it out. So how to minimize that risk? This was all the rage, this LDI, saying, look, forget equities. Let's just get into bonds. Let's get into government gilts, long-term debt. So LDIs, it's about financial engineering using debt. So what happens specifically, the LDI, you hedge the movements in the liabilities. It's a hedge in liabilities which are caused by changes in inflation or changes in interest rates. So that's what these hedging products do. They basically are meant to bet against any changes in inflation and interest rates. So this is so rife in the pensions world. The amount of pension funds liabilities which were hedged via this LDI strategy in 2021, 1.6 trillion pounds. So this is just, like I said, there's a lot of this stuff going on. So using derivatives, financial instruments, to minimize risk of having to not have enough in the pot to pay out. But what actually happened here? So when you enter into this LDI, if you're a fund manager of a pension fund, you have to put up some collateral. You have to put up collateral as part of the derivative process. That's fine, you put down some money. But in the case of what happened after the 23rd of September, the yields rose. So like I said back here, the yields move inverse proportionally to prices. So the yields rose, which means the underlying asset values fell. So the asset values in the pension fund fell. Because like I said, they're all invested in bonds, not equities. So all the value of the assets dropped because the yields increased, the interest rate went up. The price of the assets came down. Therefore, because they're worth less, they had to increase the collateral as part of this LDI hedging arrangement. So all these fund managers had to basically put down more collateral. So they had to find more cash. Now, a lot of them, yes, they've got billions and billions of pounds of cash, but they had to come up with so much cash so quickly because the rate rose really sharp. So the yields went from a modest amount to really, it wasn't a staggered increase. It took off literally that day. The yields did. So basically all these pension fund managers, they didn't have enough cash. So when you haven't got enough cash, what do? You go to your next most liquid asset. And the next most liquid asset in the portfolio is gilts, is these government bonds. Cash is the most liquid, then you've got these government bonds. So they had to sell a load of government bonds, okay? But there were so many pension funds simultaneously selling all of these government bonds that basically that pushed the yields up again, because again everyone was selling them, so the price of them went down, so the yields increased, so it pushed the yields up. So which in turn meant there was more collateral payments needed under the LDI hedging strategy. So it was a vicious spiral. This is what they've done quite a good job of explaining this on like the 10 o'clock news, showing a circular diagram of how it kind of works. But it's like a vicious cycle here, so that you need to increase the collateral, but you sell, and you have to sell all the bonds, which in turn increases the yields, which means there's more collateral, and it wasn't sustainable. That's when the Bank of England stepped in. So the Bank of England said, right, we're going to buy long-dated gilts to basically manipulate the market, for want of a better phrase, to suppress the yields and bring the prices back up. So the price rose and the yields came down, which means the interest rate came down because the bank intervened. And they basically bought up all these bonds, and they said they will do a 65 billion support package, 5 billion a day for 14 days, which ends today on the 14th of October. But that was the idea, that them buying all of the bonds will raise the price, basic supply and demand in economics, and the yields will go down. If the price goes up, the yields will go down to counter the problem up here of the yields going up, which of course has the knock-on effect of mortgages and everything else. So that's why the bank intervened to bring the bond price down, the bond price up, and bring the yields down. So in other words, they've actually started quantitative easing, even though the economic plan for the bank, the monetary policy, was to actually go to economic tightening after more than a decade of quantitative easing, but they've gone back to it. They've been forced to go back to it to sort this problem out. 5 billion a day for 13 days, where basically the Bank of England buys bonds with printed money. It's quantitative easing, QE, but that is why they've intervened, to basically get the price of these bonds increased and the yields down, and then hopefully that will do the job. But we shall wait and see. So if you like this video, very technical, I know. But like I said, a lot of people said, look, this was a ticking time bomb. These, like I said, 1.6 trillion of liabilities hedged under this LDI strategy, where all the pension funds have bonds instead of equities now, because that is the de rigueur since the early 2000s for defined benefit schemes. Now, I think it's safe to say that we're not saying that people's pension funds are at risk, but it's just how the financial engineering is at play to manage the potential exposure, which has caused all of this chaos, based on a strategy that no one had heard of 20 years ago. But there you go. So if you like this video, please do subscribe, and as always, I'll see you soon.